It is Tuesday night, October 9th, and I'm going to cover a few charts tonight. I've mentioned Apple frequently on the blog recently, and I wanted to point out what's going on with Apple here, what to look for. There's maybe some obvious things and then maybe some subtle things to look for when gauging Apple from this point. First off, Apple has had a nice long uptrend over the last few years, and in fact since the bull market lows of 2009, and then from this spring through this summer, it formed a cup with a handle type of a basing pattern. It broke out of that basing pattern initially on low volume, and then the volume did pick up slightly as it pushed to new all-time highs here. Since then, there's been some loss of momentum. Volumes kind of tailed off a little bit, and then the market has seen some increased volume down here on the selling since the high. Now, when you look at a cup with handle pattern, the breakout point is the high of the handle. So from a chart standpoint, once you see the cup with a handle form, ideally you should see a breakout above that high of the handle, and you should see so on significantly increased volume. We didn't really see that here. Now we did get some increased volume up here. I had mentioned that weak breakout was possibly a red flag on Apple, but I guess we can let that slide. It didn't really pull back down below the handle. It did sustain the breakout there. Now what's going on here is I mentioned recently how the market had tagged the 50-day average and immediately reversed off it, and how program trading often comes into stocks or major ETFs at these certain moving averages and kind of automatically kicks them back into buy mode. However, the initial rebound was weak here, and it came on lower volume, and then the market came back down and actually closed below the 50-day moving average here. Not surprisingly, the way these worked, it gapped down the next day, and then we've since seen a 2-day sell-off here. And I mentioned that once this prior low, that test of the average, once that fails and the market moves to a new low, a lot of times you can see a relatively fast decline. And we did see that the last couple of days here, though it's been pretty short-lived. So what we're seeing now in Apple is a pullback to close to the breakout point of the cup with handle pattern. So this 620 point is the breakout point. A relatively common pattern is for growth stocks is once the pattern completes and the breakout is successful for the market to advance modestly, maybe roughly 10% or so. And in Apple we saw maybe even a little bit better than that. And then the market will pull back to find support at the prior breakout point before reversing higher. However, particularly on a weekly basis, the stock should not close back below that breakout point. So I've noted several times recently that if Apple closes back below that 620 level, that's probably a negative for the stock. So what we're seeing here is the market pulling back, finding support, and then forming a reversal bar at the lower Bollinger Band here above this support level. So this is potentially an upside reversal point for Apple. Now, the Bollinger Band configuration is such that the bands have expanded the last 2 days as the market has declined. So that's a volatile Bollinger Band configuration where you have the market hugging and closing below the lower band and the bands expanding. The declines can be relatively rapid and sharp as long as that's the configuration. Now, what we did see is a reversal and a close in the upper part of the range on pretty heavy volume today in Apple. So here is my take on this, and I've seen these many times, and this is what I will offer to you as possibly how to gauge this on Apple. This reversal, for the bullish case, this reversal should hold. It's a heavy volume one. It's at the lower band. It's above the breakout point of the base. So if the market were to bottom here, form a swing low, that could potentially be used as a buy point and would be a relatively typical safe add-on point for a growth stock. However, if the market price comes down and closes below the low of this reversal bar, my experience would tell me that you're probably going to see a major base failure, and you'll probably see some accelerating type of losses as the market closes below there. You may see some gap downs and some relatively rapid vertical moves back down towards the to the low of the prior base, and oftentimes undercut that base before price stabilizing there. But in any case, we look for the price to move back towards that base low somewhere around the 525 level on Apple there. Now, being that it's October, earnings season is coming up here. In fact, just started today, and Apple typically reports. I haven't checked the dates, but typically reports in the third week of the earnings season. So they'll probably report somewhere around the 20-something of October here, and so we have a potentially big price move coming up in Apple. So what we want to do is really watch this here. And my suggestion again is, if you're still long the stock, that's okay. It hasn't had a major breakdown yet, but a weekly close below that 620 level, I would say get out. And in fact, given the current setup on it, any price close below today's low, I would say that's a pretty clear get out signal as well. Now, what may happen is with earnings coming up, it's possible that that price stabilizes above the breakout point until earnings, and then you see a big move on earnings. A gap down could take it back below and really create that base failure, or it could gap up and could move to new highs. I don't know, but that's something to keep on your radar with earnings coming up here. This could be a very, very important earnings announcement, and it could lead to a sharp move. Let's say the earnings come out negative or whatever, and the stock gaps down. You're probably going to see the stock rapidly move down to this prior base low point there. So that's a somewhat detailed take on Apple. I know it's the very widely followed stock, and many people are, if they're trading, they may be trading that stock, or they may be holding that as a growth stock. And my experience of working with traders and of working with myself on trading is that most people can do reasonably well at finding buy points, and we're trained on buying stocks, but few people have really mastered the how and the when of recognizing key selling points in stocks. So on this blog in general, I try and put more detailed information on selling points and on topping patterns than I do on bottom patterns. I just think bottom patterns are relatively easy and relatively straightforward, whereas topping patterns take a little more experience and a little more detail to correctly identify those. Now on to the general markets. This is a chart of the S&P 500 cash index, and there's a stochastic study down below here. And I've mentioned before on the blog using the stochastics with a trailing one bar higher low type of signal to actually initiate trades, as opposed to just purely going off the stochastics cross. The stochastics indicator may stay conjoined or intertwined at extreme levels for periods of time, where just looking at a cross in and of itself might not be significant, and it can also lead to whipsaw type of patterns. Like, for instance, here we saw the stochastics cross down, and in a mild correction, only to cross immediately back up. And if you just use the stochastics cross itself, you oftentimes get whipsawed and out of a trend before the trend is really reversed. One way to actually increase the probability of those stochastic signals is to not just buy on the cross of the stochastics, but to require a new higher low above or below the bar that gives you that cross. And let me kind of give you a picture of that here. So in this case, the stochastics, or the market has come up here, and the stochastics made a cross down right here on this bar. However, what I'm suggesting is rather than immediately short or sell at that level, wait for price to actually come down and trade below that level, or you could even require a close below that level for added confirmation before initiating that trade on the stochastics signal. If anybody's seeing goofy stuff come up on the screen here, I'm having obviously some type of internet connection problem, so hopefully that doesn't mess anything up and ruin the flow too much here. But back to the markets here. That's what I am looking for on the S&P 500 is for a weekly close below that week ending September 28th in order to trigger a sell confirmation and a likely correction to this recent leg up in the markets. Now, going over to the NASDAQ 100 here, the NASDAQ 100 was the strongest index and really has led the rally and really has led the bull market since 2009. But what we're seeing here is the initial decline off of the recent September high and the rebound. The NASDAQ has actually been the leader to the downside. So this initial low of the recent correction on September 26th was broken today in a somewhat convincing fashion on the NASDAQ, whereas if you look at the S&P 500, here's that corresponding September 26th low. The market is still above that, and that's same deal for the New York Stock Exchange here. The market is still below that point. We did see the Russell 2000 actually break below that point as well today too. So the smaller cap stocks are apparently leading to the downside on this correction. So if one is looking to short or trade inversely, I would be looking at NASDAQ and Russell 2000 more so than S&P and Dow. But again, here's kind of the point of this analysis is that whenever you're looking at topping patterns, tops can be difficult to predict to some extent, and they're a little bit more lazy and drawn out than bottoming patterns. Bottoming patterns often happen sharply. Topping patterns may happen with a more of a rounded type of a look or more of a sloppy type of a look than bottoming patterns. So sometimes it's good in topping patterns to require some confirmation of the top before shorting or exiting, as opposed to a bottoming pattern you may jump right in just based off of oversold conditions or something to that effect. So this chart is the Dow here, and the Dow actually made a slight new high on Friday, the October the 5th here, and what that's creating is really a support level here at that September 28th low, and the corresponding low on the New York Stock Exchange at this level. You see it failed to make a new high. Also the S&P 500 slightly failed to make a new high. So just from a support or resistance standpoint, a break of that low, which is what I just showed on the weekly chart, would be a likely obvious failure point for this rally here. We've had some relatively contained pullbacks to higher lows since this rally has started. The market has moved up, and this is a relatively nice measured correction similar to these prior corrections. If price comes down and breaks this low, though, this correction will definitely take more time than any of these corrections, and it will only take a little bit of further move down for it to become larger than any of these corrections. So that's going to create what I call an overbalancing of price and time, where this correction is now kind of out of character with the trend and indicates there's a larger correction going on that's correcting this whole, at least this whole leg up in the market. Now, given everything I've covered in recent weeks regarding the smart money heavily selling at these levels and on this breakout to new bull market highs since 2009 and the divergences that have shown up, my opinion is that this price support level here could be a continuation point for a downside move. So rather than the market finding support at this level, we may see that when the market hits this level, there's either a continuation to the downside or just a slight pause prior to a continuation. So there are certain inflection points where stop levels accumulate, and once that's hit, it kind of triggers a continuation move versus a reversal type of move. So that could be used as a short entry signal on a longer term basis, or if one is long or long specific stocks, you could use the general market averages as a proxy here, and if the price closes below there, you could use that as just a generalized exit signal for growth stocks in general. So those are some specific actionable signals that hopefully are beneficial to you in your trading here. And what I think the setup to look for here is this is an hourly chart of the SPY ETF. The MACD is just coming down into oversold territory. There's no divergence yet, and it hasn't crossed back up. So at this point, the short-term trend is still down. And what I would look for is, shorting on a break of that low with a stop here, and look for a minimum move down to fill this gap up here. I think would be the likely minimum chart target based off of that, and based off of the size of this kind of lower swing high here, double top type of formation. So that would be an initial target there to fill, to cover at least part of the short position at a fill of that gap level. However, if the market comes down here and we see the MACD or some of the technical indicators form a bullish divergence there, that's going to be likely in the region of the 50-day moving average and some of this other support in here. So that would be a place to, if you potentially look to go long or cover the positions if there is not a continuation type of a move once this low is broken. So hopefully that's a somewhat comprehensive take of what to look for here on some different time frames on stocks, and I will try and update, probably not update again till this weekend.